Welcome to our joint University of Southern California, Marshall School of Business, Initiative on Digital Competition, and Latham session focused on antitrust implications of tech acquisitions and the impact on founders. And joining us are my fellow co-host, Kelly Fayne. Kelly is at Latham, where she's a partner in Latham and Watkins' global antitrust and competition practice. She specializes in guiding technology firms to achieve their strategic objectives by navigating global antitrust regulations. Also joining us are Sarah Binder, who's general counsel at BetterUp. Before BetterUp, she served as a chief legal business executive for Lime, Young Brands, and British Telecom. She's a multidisciplinary business counselor, crisis manager, communications and legal expert in startups, especially at the intersection of new tech and law issues. Finally, joining us is Brian Patterson, global vice chair of Latham's Emerging Companies and Growth Practice, where he advises emerging companies through all stages of growth, as well as the venture capital and private equity funds that invest in them. Welcome, everybody. It's great to have you here. I'm going to start off by asking some questions. We're going to focus on what are the entrepreneurial insights on challenges and opportunities for founders. So the first is, start us off. Tell us a story. Tell us some of the success stories that you've seen. What was created? What were the business models? Brian, do you want to start us off?
Sure. Well, so I guess just to take a step back, my role is typically to, serve as a key advisor to businesses. So many of my stories really revolve around, that journey from, an idea, creating a product, taking that product to market, and then growing it over time, and then having some sort of a successful exit opportunity. So that's really what I enjoy doing, and that's where a lot of the sort of my expertise sort of kind of comes into play. So there's a lot of stories. I think founders are founders of businesses. They get into it for lots of different reasons. Some are into it because they want sort of fortune and fame. Others are into it because they're really passionate about a particular industry or a problem. I was fortunate enough, this was probably about 5 or 6 years ago now, but it still is an important story for me, where I worked with a founder. I can say his name now, it's all very public, but his name is Tristan Walker. And he founded a company called Walker & Co. Imagine where he came up with that name. He was very successful before founding the company. He was a Stanford graduate, I believe MBA. I think he worked at some big tech companies as well, and then he was also, I think, an entrepreneur in residence at Andreessen Horowitz, which is a major venture capital fund. And he created this business called Walker & Co., which was really his whole goal around the business was, in his words, sort of to create the Procter & Gamble for people of color. And that was really the concept behind the business. So obviously a very ambitious goal. Something obviously that hadn't really been done before, not your prototypical business, also for Silicon Valley as well. So that was a fun project. Also, he's a friend of mine as well. So, getting, sort of working with him to socialize that idea was not necessarily as easy as I think he originally thought it would be, just because coming out of a venture fund like an Andreessen Horowitz, you would think, that's sort of going to be an immediate opportunity to get a business funded, but it actually took a few meetings and some time to kind of get through things. He raised several rounds of funding, and then this was around, I believe, 2018 or so, where there was a bit of a correction in the marketplace, and so the money was sort of turning away. Really similar to what we saw, I think, in the last few years in the startup ecosystem, where the business, sort of rather than focusing on growth, venture capitalists were really focused on businesses that had really strong unit economics, perhaps were hitting profitability, really focused on those kind of bottom line numbers, and not so much growth and not so much visionary ideas. So it became a bit of a challenge. Also, you had supply chain issues, to deal with overseas and other things of that nature. So really sort of working with that founder to kind of grapple through it. He did an amazing job in sort of keeping the boat afloat, raising the capital that he needed to. And the irony of everything is that he actually ultimately sold his business to Procter and Gamble in a very successful exit. So that business is still, doing well today. There's a brand called Bevel that you still, you can still see it in retail, big retail. And he's someone who I think was a pretty dynamic founder who sort of epitomized, in my view, sort of what it is to be a founder. Just really gritty, really sort of resourceful, and had a strong conviction. And being able to advise him through that whole sort of ups and downs of that life cycle was definitely a joy in my career.
What about you? You've been involved in many successful companies and helped others along the way. Do you want to help give us a flavor of what does it feel like to work in one of these success stories?
That's a great question. Well, I think what you can say is it's never, ever dull, ever, not for a moment. And certainly, I think similar to Brian, by working in tech, you are always at the forefront of the most innovative, exciting concepts and ideas that are being developed and tested out. And that's obviously an incredibly exciting and fast-paced space to be in. I was thinking about this panel earlier, and I think one of the things is that particularly in tech, you have incredible visionary innovators who are breaking barriers and looking at something traditional and trying to think of a new way to do it, or coming up with a new concept entirely. And that thought process can sometimes be at odds with a much more structured process that essentially the law is built on. And so I think you do get into conflict in those types of situations. And for me and for Brian, a lot of our role is working through how you facilitate that tension and resolve it in a way that works, for the business. I also think that you see a tension because, particularly with a lot of legislative concepts, I think people have this perception that it is very binary, that it's very clear one way or the other. And I think, as we all know, in the practice of law, it's absolutely not that. It is normally incredibly gray. And I would say, particularly in the area of antitrust, it's incredibly gray and unclear. And I think that also is something that, when working with founders, can also be quite challenging and complex to deal with. And you definitely need a new way to talk about it and approach it.
Take us in the following direction, if I may. You're in one of these dynamic companies, and you have this inflection point. You've scaled up to a certain point, sort of look around, you figure out what does financing look like? Can you scale up further? What does revenue growth look like? And then at some point, someone comes to you and says, we might want to acquire you. So you have this inflection point. Do you get acquired, or do you say, no, we're going to roll the dice on IPO? What are the kind of factors that you weigh? Sarah, maybe we could start with you to understand this, and then we could talk about antitrust risk in just a little bit. But first, I want to just set the broader stage of how you think from the business side about these issues.
Yeah, it's a really good question. Transparently, I've actually been more on the side of being the acquirer. So having worked in bigger companies like British Telecom and Yum Brands, a lot of my role was looking at potential acquisition targets. But the way that you have those conversations is incredibly important. I think a lot of times people think that it's about the deal on the table, and a lot of the times it's not. It's about the relationship. It's about the trust, and having a belief that your business, if you're a founder, is going to have the trajectory that you want for it, if you are acquired or not. So I think a lot of it is about relationships, which I think often gets missed, and that actually a lot of it, if you're a founder, is spending time with the potential buyers, whether it's a PE fund, whether it's a strategic buyer, and really thinking and feeling comfortable with the vision that you have and that the acquirers have for your company. Yes, obviously the deal terms and everything come into it, but I think where it tends to go wrong is where it's seen as purely transactional. It needs to be much more relationship driven. And certainly when I was at bigger companies, the successful outcomes we had and the successful integrations we did were where there was deep, true alignment between what both parties were trying to get out of the transaction.
Brian, what about you? You've also been on both sides, acquired and acquiring. How do you think about this inflection point?
Yeah, no, it's a great question. So I agree with everything that Sarah said. I think that, and I think, the old adage of that, great companies are bought, not sold, I think definitely stands to be true. So I think if you sort of seek, an acquisition, there's oftentimes you come up a little bit short on the sell side if that's, you're putting everything into that boat. But sort of taking a step back as far as, sort of your scenario that you laid out, I think that there are a lot of, for a venture-backed startup, there are a lot of things that go into that decision. One would be your capitalization table and the investors around the table, and how do they think about the price? How do they think about where the company is in terms of the value that it's created? What stands before the company in terms of future value that can be created? Sort of how is the company operating? Is this a company that has a large enough market TAM that it could actually be a public company? And is there funding available that, or resources that to get the company to that stage? So you have to go through all those various iterations to think things through. Obviously, the management team as well. They're, to Sarah's point, the management team in your traditional venture-backed business, they're critical to the transaction. In large part, the transaction doesn't happen unless they're on board with it. And usually they're not only on board with it, ideally they're excited about it, that they can sell the deal to their teammates, et cetera. So I think there's a lot of conversation around the board table that takes place along that paradigm as well. And then, if you think about sort of this dynamic of, go public or sell, most, sort of certainly there are far more acquisitions, far more companies go through an M&A process than go public. And that's particularly true in the last several years where, the IPO, the number of IPOs is extremely down. Hopefully that'll change this year. We'll see. But I think most companies are sold. So then the question is timing. And, you want to make sure that, the partnership is the right partnership. Again, to Sarah's point, the relationships work. You want to make sure that from your stockholder perspective that you're going to have sufficient support around the table and around your stockholder base to get a deal done. There are some regulatory considerations, which Kelly can speak to, of course, here as well. But there's sort of multitude. And I think, there's some companies that are just, you can almost see from the beginning that they're likely to be M&A candidates. And there are companies that are kind of moonshot ideas, potential IPO companies. So I think it's sort of, sometimes it's written from the beginning and you can sort of see that as you move forward, but it's important to have those conversations along the way as well.
Yeah, actually, remind me, Brian, something you said. I think I saw the other day that only 4% of tech startups end in an IPO, which means that actually the chances of that happening are incredibly slim. And I think it is talked so much as being the only exit, and yet it is in fact, and particularly now, like actually quite an unusual outcome for exit.
Right.
So, Kelly, it sounds like someone was going to pass the baton, so to speak, on to you, or the mic, maybe is better way of putting it. So I'm going to stall for time for you to think about the answer and say, oh, so how do you begin to explain antitrust risk generally? So you've just heard from Sarah and then Brian about the importance of relationship and making sure there's a good fit. And then there's this thing that may or may not happen, called a merger as the basis of exit. At some point, someone like you, but in this case, the actual you, gets brought in to explain how do we think about antitrust broadly? Why does it matter? Because we have a large company buying a smaller company. Why does this even come up?
So I'm gonna mess with your question a little bit and just take it back to what I think is often kind of a record scratch moment, and it may be kind of from the perspective of a smaller kind of startup, or maybe from the perspective of someone looking at acquiring a smaller startup. You just and start from the perspective of the startup. They've spent the last, I don't know, several years just kicking and scratching, trying to build something. And feeling very much like an underdog, feeling very much like they're barely hanging on, like, you know, running round around in funding. And then they hit this moment in antitrust where they're facing down kind of a process with regulators, and the regulator is going to look at them and say, you know, start with this testable hypothesis that they were going to be the next biggest competitor on the block. And that just is like very surprising to someone who has spent a lot of time thinking, oh God, I wish I could be the next greatest competitor on the block, but I live in the real world and I'm trying my best, but I'm not going to get there, right? And all of a sudden you're dealing with a regulator who is saying, well, the but-for world, if I block this transaction, is that you grow into this massive competitor. And I've found documents in your files that project extraordinary growth. And then it's very difficult for a founder to say, well, no, when I projected my extraordinary growth, this is the best case scenario for me, but you can look at my investment dollars and see that by and large, people are not buying the best case scenario. And I think that disconnect, which exists in particular when we're looking at venture-backed firms and antitrust regulators, is really strong, because they're in completely different worlds and they don't really speak the same language. You know, antitrust regulators are not thinking, you know, this company had, when it started, a 4% chance of IPOing. They're thinking, man, this company's probably going to IPO, right? And if this transaction doesn't happen, they're going to do that. And connecting those dots, and the exercise of helping the regulators understand the reality of the competitive environment, the context for the documents they have, and then simultaneously helping the founder understand, like, I know you've been selling yourself for 3 years, but like, I need you to walk into the DOJ or the FTC and like speak the truth of the headwinds that you face, so that everybody understands like why you've decided to take an M&A exit as opposed to an IPO exit. And frankly, like, if you could take the IPO exit, you take the IPO exit. Like, no, it's very hard, and it's a rare and perhaps a null set of companies who can buy somebody out of an IPO. And that, I think that is not an intuitive thing to the world of antitrust regulators in the US and around the world.
That's incredibly helpful, because I think it puts all of this into perspective. So based on what we've now already heard, IPOs, which used to be great, well, we just have a lot fewer of them. So if M&A is the basis of the thinking, I guess the question is, when do we do it? And then we'll get to, maybe Ken will bring you back in and say, when does antitrust come in to sort of help shape that moment of when do we do M&A? So maybe Sarah and Brian, you could just give us a sense of, we know that there's going to, more likely than not, be some form of M&A. And the question is, and Brian, maybe I'll even tweak it, a special thing for you, acqui-hire. So we're assuming that the M&A is the company, but in fact, it might be some human capital and nothing else that goes with it. At what point in each of these points is it like, it's not going to be IPO? When do we sell? When do we sell? When do we sell? Because that's how everyone gets their money. Sarah, you've been on the acquiring side. Brian, you've done it both ways. How do we think about this little twist? Brian, maybe you could start us off, and then Kelly will tell us where the antitrust risk is going to come in.
Absolutely. So I'll start with talking a little bit about maybe how some of these acquisitions come together that I've seen or been a part of, and then we could talk. I'll kind of weave in, talk a little bit about an acqui-hire and sort of kind of how that has shown up, certainly in recent years, especially. So, I think. Sarah was right on point where she sort of said that the partnership is key. One of the pieces of advice I always give every company, no matter what stage, is know who your potential acquirers are and start to get to know them very early from a just general relationship perspective. Maybe you start a formal partnership with them, maybe you don't, but you don't want to be in a position where when it's when you're running out of cash in 2 months or something along those lines, and you have to sell, and you're pushed in that position that you're sort of stuck with zero relationships. So, and the downsides there. So I think it's important just to kind of know who your acquirers are, and also for an upside perspective, just because you want them to know about you and get excited about you and that sort of thing. So, I think over time, as companies start to build, I think boards tend to have conversations about where is the company land, where is it, how is it expanding, how is it growing, what trajectory is it on, does it have the metrics for an IPO? As we just described, that's a rare instance when that's the case. But and so you start thinking about sort of what's the right timing for that type of a transaction. For some companies, that's fairly early on. They just build a product that someone wants. And then other companies, they build, kind of a bona fide, legitimate business with real revenue that's attractive to a buyer, real product, real market, et cetera. But they just need, a bigger partner to sort of take the business to the next level. So those conversations have to happen ongoingly at a board level. In terms of the acqui-hire, that's something that has been around it's probably been around even longer than a decade. But I'd sort of say in the last decade is sort of when you've seen that quite sort of really take its form, especially in Silicon Valley and tech. And just to take a step back, what is an acqui-hire? An acqui-hire is essentially it's a talent acquisition. So rather than a buyer looking to acquire the entire business or the stock of a business, and so to take that entire business over, the acquirer is really interested in the people. So they want to buy the talent. So they're looking to structure incentive compensation, bonuses, sign-on bonuses, retention awards, et cetera, to essentially hire those employees away from the target company. And the big key is, especially for the VCs out there, that the proceeds in those transactions, they don't flow to the investor base or the other stockholders. It's really compensation. It's compensatory compensation. And these transactions can be very small. Sometimes you hear, companies, they're going to pay $500K or $500K or $1 million per head per engineer that they buy. Other times, like it can be, very sizable businesses that are, hundreds of millions of dollars, even billions of dollars sometimes in certain cases. So that's sort of the historical acqui-hire. I think what's changed in the last couple of years, and particularly with the onset of AI, is I think some people refer to it even as a reverse acqui-hire, where it's a talent acquisition. It's and it's the same transaction where you have proceeds that are flowing to the team and not to the stockholders. But you really sort of these are businesses that are previously. In the old acqui-hire model, you would at least see a license of some technology where the business would sort of try to take over some of that technology through some sort of a license or an asset purchase of the technology. And these acqui-hires, they're really focusing on the people, and they buy the license. They might get a non-exclusive license to the technology as a sort of a secondary afterthought, which is more of a in AI deals, they're looking to maybe license the models or what have you. And these businesses, rather than essentially being, kind of going away after the transaction, they actually stay in place. And there might be, some employees that are left behind. It still owns its technology. It can license it out to other businesses as well. And there have been a number of these more recently done by some of the bigger strategic acquirers in tech that have gotten a lot of headlines. The Character AI deal, I think there was one with Amazon, I think Covariant, I believe it was called. Microsoft did one as well, Inflection deal. So those transactions are, these businesses are actually businesses that have raised, in some cases, billions of dollars in venture capital, hundreds of millions of dollars in venture capital. And the return that actually comes to play for the investors is quite small, as you would think of it, sort of relative to what the team that's being acquired is receiving. So those have gotten a lot of buzz. There are certainly antitrust implications that Kelly will speak to, but I'll hand the baton over to Sarah to see if you have any additional thoughts.
Yeah, sorry. I guess Danny, what exactly would you like me to focus on? Oh, sorry, you're on mute.
I think that's most people's fantasies. But the question is really, what's the right moment to sell? And so there's an idea that you're going to sell. How do you figure out that right moment? How do you convince your counterparty that it's time?
Well, it's definitely an art and not a science, for sure. There are just so many things that go into that decision. And I also think that for a lot of businesses, particularly founder-led businesses, you're very focused on your product and your customers and building that out, which means that you're not necessarily planning exactly when the right moment would be to be acquired or potentially to do an acqui-hire or whatever it is. So I think a lot of it is opportunity. I do think it really helps for founders if they have either somebody on their teams who is thinking about that, whether it's sort of the long-term strategic piece, or they have somebody thinking about business development or corporate opportunities, so that you're in the market and you know what's available. And that someone who's thinking innovatively and creatively about the different directions that your business can go in and how it can grow. But I do think a lot of it is kind of opportunities that present themselves. I don't know of many companies that have sort of like mapped exactly when they want to be acquired, etc. It tends to happen kind of more organically. But I do think that it can be very easy as a founder to have your head down and be very focused on building your company and building your product and not thinking quite so much about what and when your exit looks like, and thinking about the other opportunities for an exit. And as we were talking about, which aren't just IPO, they are multiple kind of M&A opportunities as well.
Kelly, when's the right antitrust moment? Because apparently there's only one.
The right antitrust moment to be acquired or to acquire. I mean, there really isn't, right? I mean, I think Sarah's exactly right. Like, these things kind of come up fluidly. You need the right confluence of moments, none of which have to do with antitrust in terms of like, here's a really solid example, right? So from the last administration, I think there was a lot of discussion about the antitrust regulators, especially in Europe, causing companies not to do as many deals, right? And especially around private equity and maybe some venture capital deals. And that a lot of that was attributed to the Khan and Cantor administration, which is one possible explanation. The other possible explanation is that we have seen, with increased regulatory focus, kind of extended timelines. Extended timelines mean that any sort of debt finance deal requires more debt. That got very expensive over the exact same period of time. So all these deals, right, may have been done and people may have been willing to have the fight with the regulators on the merits if it had been more affordable. But we had both an increase in regulation and an increase in the cost of fighting for an extended period of time. And I'm not sure like what the last 4 years would look like if debt had been cheap. It could have looked very different and with a lot more litigated cases. So I in terms of the right time for antitrust, I think it's just what you want in an optimal deal for antitrust regulators is something that you've got. I mean, in reality, they're supposed to review the transaction on the merits and make sure it's not anti-competitive. The reality is you want to take your deal in and give them a pro-competitive narrative. And if you find a deal partner and the economics that work, when you can say there's a real case for consumers, if you're consumer facing or businesses, that the two of us together are going to create something better and innovate faster and more efficiently, and you have that story to tell, that's a really good time to be doing a deal.
Yep.
That's incredibly helpful. I'm going to just move to another question. Can you tell us a story maybe about your serial entrepreneurs? Start a company, get acquired, start their next company. How often do we see this, that you're dealing with these kinds of settings as opposed to the one and done? Brian?
Happy to take it. So I actually think, I don't know, I feel like almost anecdotally for the larger acquisitions these days, more of the founders go off and become VCs than they do, repeat founders or entrepreneurs. But there are some. I'm working with a few right now that are fun. I mean, those relationships are always great. I think that I'll just give you, I guess, one or two stories. So there was actually one really interesting one, the company that I'm working with now. They founded a company called Kaggle that actually was sold to Google. This was probably like 2018, 2019 timeframe. They were, I don't think they were a YC company, but they kind of came out of the gate raising a fairly large amount of money for the time. Were kind of one of the hot startups on the street. They were doing machine learning, kind of when everyone was talking about big data instead of AI, that's sort of the time frame that they were sort of getting going. And they, kind of found a few different models for their business and hit some headwinds just beginning. There were some macro issues that came into play, but also there were so the industry that they were really focused on was kind of struggling a bit as well, which impacted the business, and it became difficult. And then they had, to their credit, they created, sort of a Hail Mary funding round that put the company kind of back on track. And then they moved forward and actually ultimately built the business up more and sold it to Google in a successful deal. So that was a fun team. And then they, I think one of them went off and became a VC. The other one, I think, stayed at Google for a bit longer as an engineer. And they gave me a call, I don't know, maybe 18 months ago that they were going to go and do their next thing, which is, I think, very much in line with where the industry is going. I think they learned a lot of the first go round. It's always funny when these founders come back and they set up their new company, they usually have very strong convictions on how they want to structure things as compared to how they structured them the first time around. So that's always a lot of fun.
By the way, Brian, in the academic world, we call that learning by doing.
Yeah, absolutely. Absolutely. And so, and what's great about it is too, because especially if you have a case where you were successful and you did help, VCs did make money and the Sokol base made money on the transaction. There comes credibility with that. The fundraise for the next company was much easier. They raised a nice round kind of right out of the gate. And so they're off. The stories yet to be written and still being written, but that's a fun team. It's always kind of fun to kind of get the band back together. I guess I have one other story I can tell. Another founder that I worked with in the ed tech space sold his company. In this case, he actually sold his first company fairly early. They raised a couple of rounds of financing, but it wasn't a tremendous, maybe, I don't know, they might have raised $10 million or something like that. But they had this is kind of one of the decisions also that companies always have is sort of, do you, if you get a really interesting offer very early on, even before you've had a chance to really try to scale your business, but it's sort of a life-changing offer, particularly for the founders. Do you take that transaction? How do your investors feel about you taking that transaction or not? But so he had a successful outcome in his first company, and then this founder actually went off and he I think he was a bluegrass singer for a little while. I think he bought a ranch in Nashville. And he also then ultimately ended up running for senator in the state of Maine. Very eclectic founder, good friend of mine. And then he came back and he started a new company. It's called Zigazoo, which is actually one of the leading companies around on social for kids in terms of it's sort of like the safe version of TikTok. So a lot of the talk that's going on right now with TikTok, they're very much on the pro side of that in terms of being a safe resource. So he created that business, which is fun. Again, very much the second time around was very thoughtful in terms of what he wanted to do, had a lot of strong convictions, that much smarter, having gone through it, understanding how to raise capital, understanding how to work with a board, manage a board, et cetera. And it's fun to kind of be in the middle of that and sort of kind of help shepherd that ship forward.
Sarah, we just heard about someone with a spectacular story, running for office in Maine, bluegrass singer, and all this other cool stuff. Tell me you can top that.
I don't think I'm trying to think. I don't think I can, but what I can tell you is that I think, particularly with kind of like a sort of more of an acquirer hat on, getting that relationship right with founders that you integrate into your wider business can be challenging. And that was my point of like, when you do an acquisition, everybody being really clear on what they're bringing to the table, how it's going to work, how the transition period is going to work, how that integration works, what your timing is to remaining to going off. Because I think you can have scenarios where you have a number of founders who are kind of counting the minutes until they can go off and do their own thing. You know, founders often are people who have chosen not to be feel in some way constrained within a bigger organization. And so I think like having the awareness as both a founder and as a company acquiring of like what that's really going to look like, and is everybody getting what they anticipated, is really important. Because I've certainly dealt with a number of challenges of businesses that weren't really assimilated or ready to be assimilated into a bigger organization, and that can be really quite complex to deal with and really just downgrade the value of the acquisition, not just from a financial perspective, but really from, you know, what both parties were bringing to the table. But yeah, I've certainly heard plenty of stories of founders who have done multiple, you know, 2-3 successful exits, and that's a real gift.
Wonderful. So I'll ask one final question for all of you, which is, once again, antitrust rears its head. And you want the good integration, you want the serial entrepreneurs, you want the acqui-hire, you want any of these things, traditional mergers. And then there's been the last few years where it's just been harder to get deals through. How has that impacted the market? How does that impact risk-taking? How does it impact the types and the numbers of acquirers that you see? I'll let maybe Sarah, you start, then Brian, and then Kelly, maybe you'll give us a sense from the pure antitrust side of some of these difficulties you've had to help navigate clients through. Sarah? I
think, yeah, the last few years has not been easy. It has not been easy to get deals done. I think also particularly in perhaps more niche sectors or where companies are smaller, I think that there can be an overly prescriptive view from regulators about what the size of the market is or what the market really is. And I think the challenge is that a lot of these companies, particularly in new innovative sectors that are challenging the status quo, they just do not have the financial capabilities or the time bandwidth to wait, 12, 18, 24 months in order for a deal to complete. And so I do worry that in some sectors, antitrust has had a potential chilling effect actually on the ability of particularly new sector companies to be able to innovate and grow and develop. So I do think it has been challenging. I think the other thing I'd say is that because it is often unclear as to whether there will be a regulatory challenge or not, it can make it hard to have clarity as a founder, as an owner, as to whether you're going to be able to execute some of these plans or not. And so I think the lack of clarity around and the sort of, the intense focus even on very small sectors of the market has been quite challenging for founders to manage. And I do think it's chilled people's willingness to want to explore potentially serious growth opportunities, because sometimes those antitrust concerns, often it's not, you'll get to the right answer, it's going to take too long. And so I think it's a timing piece, not necessarily the outcome that has slowed some of this, some activity in the sector. Thank you. Brian?
Yeah, no, I agree with all of that. I think, and I'll keep mine short. I think that, one of the key changes, I think, in the last few years around antitrust is sort of just how it's become much more in the forefront in terms of a conversation piece in the boardroom with these companies. I think before acquisitive companies, it was really sort of, at least in my own personal experience, I had far more conversations, with some of my public company clients, some of the larger ones, where they really were worried, like, will this transaction maybe go through or not? And that's sort of an ordinary course business analysis that they actually would go through in their corporate development process. I think that has come under the umbrella of so many more companies is where we sit right now, given the current environment and the level of scrutiny. And so, to Sarah's point, it absolutely has had a chilling effect in certain deals. I think it's created some anxiety around some of these companies actually thinking, maybe wanting to move forward with a transaction, because there's so many examples, especially for some venture-backed companies that had deals that were hung up with an antitrust review, and some of which actually were kind of not they weren't allowed to move forward. So I think you have to put it into calculus as you think about the risk. And there's a huge downside to having one of these transactions terminated, because you were at one time, not to call any specific names, but there's some out there that we probably have all heard about and read about. These were high flyer startups in a high growth mode and had a lot of opportunity ahead of them. And then you're stuck in a process for 2 years or more. And when you have to come back to earth and that transaction is not occurring, you have issues with retention of employees. You have issues in the marketplace because competitors have caught up, all kinds of things. So I think it's really sort of changed the dynamics.
I think all that's right. I think the one thing I would add, right, we've seen, one thing I have to say, plenty of deals got done in the last 4 years, right? Plenty. But the vast majority of deals that got notified to, especially the US antitrust regulators, with pretty low threshold, cleared very quickly and easily. So, but we do have, what we did have was kind of an increased attention on the strategic transactions in specific sectors. So other deals in other sectors did not get as much attention, right? It was a real focus on healthcare, a real focus on tech, and some other kind of high profile industries and things kind of, especially when inflation became a thing, like things in high inflationary environments. So, especially in tech, I think that the challenge we saw is that we had an administration that was pushing novel theories that really, I mean, in my opinion, at least, do not stand up in a disruptive environment, right? So technology is disruptive. You have kind of this constant, someone's coming in, who's the next? Let's keep up with the next thing. You've got kind of network effects that create incentives. They have effects kind of towards scale, but they also have really meaningful effects towards incentives and the need to kind of push value to consumers and users. All of these like really interesting economic concepts that are not embedded in our current spectrum of antitrust laws, because all of the laws were made through like the industrial era, where like counting up competitors in a circle made sense as an antitrust exercise. And the real, like, I guess, bummer of the last 4 years is that I wish some more of these ideas got litigated in the courts in a way that we could get real guidance and answers on whether we could use a disruptive industry as a defense to a transaction that in a objectively like relatively concentrated industry, or whether we could use make more out of kind of scale-based, high-cost industries to say that there's actual real benefits to creating like 2 strong players as opposed to 3 weak players. None of that got tested because nobody had the time or the money to litigate that to completion, which means we had a lot of deals kind of die on the vine that, if they had made their way to the end, may have actually given everybody some more comfort. And I think that is the real disappointment, that we didn't get clear answers to hard questions. And we don't see the agencies, and there's hope for the future with the kind of current turnover globally in regulators, but we didn't get a lot of guidance out of the agencies that would suggest that they were grappling with these issues. Most of the guidance we saw is, especially with the most recent merger guidelines out of the last administration, was kind of a handbook for how they win, which is not that helpful if you're trying to help people figure out what they can and can't do.
I think that's super helpful. We're just about out of time. Any final parting thoughts? How do we think about this kind of risk? And is there some kind of wish list for what we want that balances sufficient antitrust attention with letting deals go through that, for the most part, don't create problems, but allow our founders to exit and allow for a better way to integrate in all kinds of technology from one company to another?
So maybe let me start first, because this is one opinion I have in observing regulators grapple with, especially technology and especially kind of companies that are startups that have grown. I think there is a real deficiency in antitrust economics in the agencies, and actually kind of far wide, to really understand the principles of venture capital finance. So the kind of subsection of corporate finance that applies to why do VCs invest? Why do founders found companies versus work for big companies? What does it mean when you have a down round after, a series of positive investments? None of that is part of the vocabulary of antitrust. And I think it makes it very difficult to do that thing I was talking about at the beginning, which is make the connection between these very opposite worlds so that they're speaking in similar terms and understanding each other.
That's really well said. I think, yes, that the terms are not understood. I think my steer would be is that if you are thinking as a founder about M&A, don't underestimate antitrust. I think there is a sense to dismiss it and think it can't apply to us because we're, fairly small or we may be pre-revenue. Don't assume that that's the case. It can quite often be part of your world, and it's better to think about it early. And I agree with Kelly that more clarity from regulators, more thresholds, perhaps, ensuring that, to Kelly's point, great deals and great ideas don't wither on the vine due to timing, would also be really valid. And I think just more clarity around the thinking of what really, to your point, Danny, that you made, what really constitutes true anti-competitive behavior or risk, and what is perhaps more in the theoretical.
Ryan?
No, I think I don't have much to add. I think that Kelly and Sarah said it best, but I think I'll just double down on the clarity point. I think that there are other forms of regulation which we've seen sort of an uptick that have impacted the space in the last couple of years. I'm thinking about CFIUS, for example, as an example, reporting requirements for foreign investment in the U.S. I think everyone, there's certainly gray there. There's some education that needs to take place, but I think everyone understands where the emphasis is there, where the focus is there. So China, Russia, et cetera. So, in terms of if you're taking investment from one of those two jurisdictions, you have to be really thoughtful about it and really understand there's going to be significant scrutiny around that transaction through the CFIUS process. If we could have something that was sort of analogous to that's applying antitrust, that everyone sort of generally understands the guardrails and the rules of the road of what a transaction looks like, that might run into some roadblocks. I think that'll only help the industry, because we have to have free-flowing M&A transactions in the economy. I think it only helps sort of the broader macro system. So I think that we have to get there.
Great. Well, thank you very much. On behalf of the USC Marshall Initiative on Digital Competition and Latham and Watkins, I'd like to thank you very much for your participation.
Thank you. Thanks for having me.